Never start trading like this, risking real money before you even know how to survive a losing streak. Because the fastest way to fail isn't a bad strategy, it's blowing up before you ever get good. If you're new to trading and secretly scared that one bad week could wipe you out, you're not crazy. Trading is the only place on earth where people will risk their rent money on something they learned from a 30-second clip. In this video, I'm going to show you 3 simple, unsexy secrets that keep beginners alive, help you find cleaner entries, and stop your emotions from wrecking your account. By the end, you'll know exactly how much to risk, when to enter, and how to stop revenge trading before it even starts. Most people think winning at trading is about some magic indicator or insider trick. It's not. You don't need a crystal ball. You need a plan that doesn't blow you up, a setup that doesn't feel like guessing, and a brain that doesn't panic every time a candle moves the wrong way. That's what we're building here, step by step. And we're starting with the part nobody wants to talk about. Secret number 1 is defense before offense. Here's a hard truth most beginners ignore. The difference between a trader and a gambler is simple. A gambler hopes, a trader plans. And your plan starts with how much you are allowed to lose on a single trade. There's one rule you need to burn into your brain. Never risk more than 5% of your total account on one trade. If you have a $10,000 account, the most you can lose on any trade is $500, not $5,000. Not just a little more this time. 500. That's it. That number is your seatbelt. And no, this does not mean you only buy $500 worth of stock or options. It means if your stop loss gets hit, the money you lose is $500 or less. That's a huge difference. A small position with a massive stop can still destroy you. A larger position with a tight stop can still fit inside that 5%. The key is position sizing, not vibes. Here's the simple math almost nobody uses. Your position size equals your maximum loss divided by your stop distance. Let's say a stock is trading at $50 and your stop is at $45. That's a $5 difference. If your max loss is $500, you divide 500 by 5. That gives you 100 shares. That's your position. Not 1,000 shares because it feels right. Not guessing, just math. This matters more than any strategy you'll ever learn because it keeps you in the game when the market humbles you. If you risk 5% per trade, 3 losses in a row puts you down 15%. That hurts, but you're still alive. If you risk 20% per trade, 3 losses puts you down 60%. At that point, you're basically done. You're not one good trade away from recovery. You're one bad click away from quitting. I've seen traders turn $250,000 into $3,000 in a single week. Not because they were stupid. Because they were betting their whole stack on every idea. That's not trading. That's playing poker with all your chips every hand. The market does not forgive that. Defense also means protecting your winners. Nothing hurts more than watching a green trade slowly bleed into red while you just sit there frozen. Once a trade moves clearly in your favor, your job changes. You're no longer just protecting capital, you're protecting profits. You do that 3 ways. First, take partial profits. When price moves a solid distance in your favor, sell part of your position and lock in real money. Second, move your stop to break even so the worst case outcome is walking away flat. Third, once the trade starts trending, use a trailing stop. As price makes higher lows in an uptrend, you move your stop up underneath those levels so you never give back the entire move. Think of it like driving. The 5% rule is your seatbelt. It keeps you alive in a crash. Partial profits and trailing stops are your brakes. They stop you from flying off a cliff after a good run. Now, staying alive is only half the job. You also need to know when to actually get in. Secret number 2 is waiting for confluence. New traders love charts that look like a Christmas tree. 15 indicators, flashing signals everywhere. and a brain that's completely overloaded. You don't need all that. You need a few tools that tell a clear story, where price is going, how strong the move is, and where buyers or sellers are likely to step in. That's it. 3 things. For beginners, I like using a 34-period exponential moving average, a slow stochastic, and clean support and resistance levels. The EMA shows you the trend. The stochastic shows you momentum. Support and resistance show you where real decisions happen. The 34 EMA is a sweet spot. It's smooth enough to show the main trend, but not so slow that you're late to everything. If price is above the 34 EMA and the line is sloping up, you're in an uptrend. If price is below it and the line is sloping down, you're in a downtrend. You're not predicting, you're reading what's already happening. Confluence simply means multiple signals agreeing. You're not asking one random person for directions. You're checking the map, the road sign, and your GPS. When they all say the same thing, your confidence goes way up. Here's a basic bullish setup. First, price is in an uptrend above the 34 EMA. Second, price pulls back toward that EMA. You do nothing yet. Third, you look left on the chart and find a clear support zone where price bounced before. You want price to pull into that area. Finally, you check your slow stochastic. You want to see momentum turning back up from oversold. Trend up, pull back into support, momentum recovering, that's confluence. Picture a stock that's been grinding higher all week. Every dip gets bought. Then price pulls back into last week's support right around the 34 EMA. The stochastic is curling up. That's not guessing. That's waiting for buyers to show their hand again. A bearish setup is the same idea flipped. Price is below the 34 EMA, the line is pointing down. Price rallies up into the EMA and into a resistance level where sellers stepped in before. The stochastic is rolling over from overbought. Trend down, rally into resistance, momentum weakening. That's where shorts make sense. Notice what you're not doing. You're not chasing giant green candles. You're not shorting because it feels high. You're waiting for specific conditions. This alone removes a massive amount of bad trades. But here's the uncomfortable truth. You can do all of this and still lose money if your mind isn't right. Secret number 3 is detaching from the outcome. Your biggest enemy in trading isn't the market, it's your own brain. The market is chaos. It doesn't care about you. You can't control whether the next trade wins or loses. You can control how you behave. Most beginners judge themselves by daily profit and loss. Green day, genius. Red day, failure. That mindset will destroy you. You can follow your plan perfectly and still lose. You can break every rule and get lucky. If you only judge results, you train your brain to chase randomness. Instead, you measure behavior. This is where the star system comes in. Every time you follow your plan exactly, you give yourself 1 star. You waited for your setup, you sized your position correctly, you respected your stop. That's a star. Every time you break a rule, you lose 2 stars. You chased a move, you moved your stop, you added to a losing trade out of anger, 2 stars gone. Your goal is 100 stars. Not 100 winners. 100 times you did your job. This flips your focus from money to process. And over time, money follows process. This only works if you're honest with yourself, which is why journaling is non-negotiable. Not emotional journaling, real journaling. For every trade, answer 4 questions. Why did I take this trade? Did I follow my plan? If not, why? And what was I feeling before, during, and after the trade? That last question changes everything. You'll start to see patterns. Your worst trades come after losses, or when you're tired, or when you're trying to make it back. Once you see it on paper, it's impossible to ignore. Think of it like watching game tape. Athletes don't review mistakes to feel bad. They review them to fix habits. In trading, your bad habits are chasing, moving stops, and overtrading. Journaling exposes them. One last danger you need to understand is reacting instead of responding. Reacting is instant. You take a loss, feel the punch in the gut, and jump into another trade to get it back. That's how accounts die. Responding is slower. You feel the emotion, but you pause. You step away. You let the feeling pass before acting. A powerful way to build this discipline is a pre-trade contract. Before entering, you write down your entry, your stop, and your target. Numbers only, no feelings. Once the trade is live, your only job is to honor that contract. You made the decisions when you were calm, now you just execute. When you put all of this together, trading stops feeling like chaos. You know your risk. You know your setup. You know how to track your behavior. You know how to stop yourself before you tilt. You still lose sometimes, but you stop self-destructing. Learning to trade takes time. You will have bad days. But with proper risk, clean setups, and control over your behavior, you give yourself something most people never get in this game. A real chance to survive long enough to get good. If you have thoughts on today's topic or something you'd like me to dig deeper into, feel free to leave a comment. I always appreciate the conversation. And if you got value from this, tap like, subscribe to the channel, and hit the alert bell so you're here for the next breakdown. See you next time.